Hi, good Monday morning, people. How are y'all doing today? It is Tyann of the Tyann Brown. It's not a game, it's a lifestyle show, season 54. I just wanted to take some time out to talk to you all about something that I titled this video this morning, this Monday morning, as when is the long haul long enough for you? The long and the short of this, okay? And I'm going to talk about one of the taboo subjects. As you know, I've committed myself to talking about the taboo subjects because they are such the pillars of life. So I'm going to talk to you about money. And then today I'm going to talk to you about investing. Well, this morning when the stock market opened, it opened down 9%, or it opened down so much so that they had to once again stop trading for 15 minutes. And if this continues again, and there will be a stop of trading period. Now, a lot of you have your 401k money and you've got your retirement savings, and the companies that you work for have them invested into the stock market. This was also at one time put out as the smartest way to invest your Social Security statements. Now, since I can only speak to and for a little bit of the 50 and older community, I'm going to tell you this, that letting your assets or allowing your money to sit in the stock market with the intention of it going into the long haul, you have to decide for yourself when that long haul needs to come to an end. And therefore you have to diversify your portfolio, not just in stocks, because stocks are risky. The stock market itself is a risky thing. And I'm going to tell you something. It is really for institutional investors. Most of us as individuals will not see grand rewards unless you know how to play the game like an institutional investor, which means you go with momentum. You look at the underlying facts. You look at history. It requires you to almost take this on as a career. So you have to determine when you're going to pull the plug on your stock market investing. Now, I see people suggesting that while the prices are going low, this is the great opportunities to purchase. And I have my own opinions about that. And since I am the one making this video, I am going to give them to you. No, it's not. They have injected quantitative easing in. They're injecting liquidity into this market so quickly. Too quickly, which means there's plenty of downturn still left to go. And when you're over 50, maybe you need to consider bonds or T-bills or something that gives you a little bit more stability. We can't call a bottom. You cannot call a bottom because it is the sentiment. You know, even though they like to make this seem as if it's scientific, there's still so much of it that is unpredictable because it deals with the emotions of those that actually pull the levers, whether to buy or sell. Now, my thing is with this last bull market, the bull market actually started under Barack Obama, and it never saw a correction. And all markets, I say correction, I'm going to say rephrase that. The term is retracement. There was never a retracement. Not really. And when you've gone as long as this bull market has gone, there was bound to be a retracement that led to correction. One is because the way in which the stock market elevated itself, or should I say the prices of the stocks went up, was not based on underlying financials. No matter what those gurus, and I don't like to use the term, but those financial pundits tell you, it went up because during the last credit crisis that you and I could not purchase things with, what was happened was the liquidity, or the credit, the ease of credit went to corporations more, for the most part, actually for all the part, except for maybe 0.1% of the 100% that was supposed to be injected into the consumer side. It went to the corporate side. And therefore, they were able to do things like buy their shares back, sit on them. And when sentiment about the market changed, they were able to then start selling their shares, which is why you saw so many prices go up of certain securities. Now, that same opportunity is being given to them again. So what happened is, along comes coronavirus, or COVID-19 as we're calling it, making it sound like something from a James Bond movie. That gave them the reason to be able to sell, because see, you don't make money in anything just holding it. No matter what the asset is, its underlying value is based upon how much money you can take away from holding that asset at the time you need to take it out. So COVID-19 presented them an opportunity, because the market was going to crash. It had been unrealistically high. It had been skyrocketing. No bull markets or bear markets last forever. So they were going to sell. And COVID-19 just gave an opportunity for the institutions to sell, but the intention was not to sell so quickly. So it caused this crash. It caused the irrational selling, caused the crash. But the market itself was going to correct. All right. It wasn't going to just retrace. It was going to correct, meaning that it had to correct a certain percentage point, or it has to retrace a certain point, and then you're out of correction, or you're out of the correction, and then it was to resume its leg ups. Well, it never did that. And a correction or a retracement can be 50%. So when Obama left when Obama took over, or the lowest point during the bear years or the recessionary time, credit crisis, however you want to put this, it was $7,200, I think, or $7,900. And when Obama left, he left at $19,000, and there was no real retracement on that. So if the retracement, and I learned this from trading commodities. So if the retracement is expected to be 50%, since there had been no retracement of any kind, 50% of a 19,000 bull market means that it would have to have retraced about 9,000 points. Well, enter Donald T. Rump and enter the second phase of greed, or basically saying you gonna get got. The market rises again, an additional it hit 29,000, so 11,000 points. There was going to be a correction. No ifs, ands, buts about it. There was going to be a correction. So if you're basing this, if you're looking at the numbers and the underlying, what I call the underlying, or pulling back the curtain so you can see the wizard who's really behind the curtain of the wizard, a 50% retracement on 29,000 would mean that the stock market would honestly have to go down damn near, I would say 15,000 points. That's why I say we're not there yet. Not quite. But they may try to save it, because the institution started losing money, because the sell orders started coming in so quickly that they couldn't stop it. But to be quite frank with you, I don't think the institutions have lost too much sleep, because they're making their commissions. And stockbrokers make commissions, and mutual fund managers make commissions. These guys are commission salespeople. They're not going to lose any sleep, because they make money whether you buy or sell. So you as an investor need to start understanding the underlying reasons that your stocks are going up or down. The valuations, as they say, things like earnings, what their earnings is as opposed to the price per share. These are things that you're going to have to learn, and you're going to have to be painfully aware of these things, and you're going to have to maintain diligence when it comes to this. Now, I would say, some people would say, well, you don't invest. I'm not a long-term investor. I'm not in stock shares, because one is I play the markets, so I do options, and which I go long, and so that's calling. And right now it's a putter's dream. If you want to put it on them, you can make money like you wouldn't believe in puts. But or futures. I started futures trading because of sentiment. But the thing with the economies and stocks for me is that it is based on one thing, one rule, and that is consumerism. Consumers. So the consumer sentiment is what all of these things, their value comes in at. And I think I've lived long enough to believe, or I know I've lived long enough to believe, that you cannot just consume, you must also create. So we have a lot of share prices going up based on the sentiment of consumers. Well, when people get scared and there's no reason for them to purchase, then the stocks are they're gonna tank. All right, they're gonna go down. And now there's no way basically we've opened up Pandora's box with COVID-19. So there's really no way to determine when consumer sentiment will change again. It will change, but it's not going to change back to what it used to be, which is just unfettered consumerism, because now we are actually all being called to create. So while you're there at home or at work and we're practicing social distancing, now is the time for you, the individual, to figure out what it is that you can create that can be of value and of service to your fellow man and to yourself. This way you can, if you're going to enter the market, you spend time studying, understanding things like PPS, price per share, earnings. You'll spend time learning all of these things so that when this next time, how your portfolio is managed, you will have a much greater input into it, and therefore you can possibly stave off the wolves when they're at your door. As I said, I'm not a guru. I gotta let you guys know I'm not a guru. I'm just someone who's been able to survive and thrive in ways that we all could do if we just study and decide that we're going to create. So this is me telling you that to decide for yourself what your long haul is going to be, so that you'll never watch on any channel or hear any financial expert telling you that you're in this for the long haul. Because if you're 55, which I will be next month, and you've seen your portfolio evaporate by 40%, you have to determine what you will really have to decide when that long haul for you has come to an end, or at least curving. Alrighty guys, y'all have a good day. It's 13 minutes time here. I love this. I know some folks go, wow, what a long one, but I'm talking about the taboos, and these again are not cliff note situations. So if you've got money in the stock market, it will rebound. Just be ready to sell it when it does. This time, get out of it. If this is too much for you to deal with, get out of it. And if it's not, then enjoy the ride. Again, it's me. Y'all have a great day. I'll have another taboo coming up later. But talking to you about that money. Get it.